Welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct. And after 3 consecutive months of gains, April is on track to be the fourth with a rise of 0.2% for the week. Early indications of improving global growth conditions through the China manufacturing PMI numbers have helped to inject some optimism into the market. So given that the macro conditions are dictating so much of market performance and volatility, let's kick off with JP Morgan and a macro view. On their QMI indicators, the move has been to a contraction state, and that means that investors should be favouring defensive yield with a focus on quality. However, given the recent market strength, easing trade tensions, the US yield curve inversion, and also the weakness of that QMI signal, JP Morgan are inclined to hold in last month's expansion state. In this state, investors are encouraged to increase exposure to forecast PE blended with dividend yield while avoiding overpriced quality. A strong overweight to momentum, both earnings and price, with a mild dose of growth and avoiding low volatility bias. The top 3 stocks in this area include Alumina, New Hope Coal, Charter Hall Retail. The bottom 3 are Galaxy, Orocobre, as well as Sierra. Having a look at those macro conditions and how it impacts on banks, and Morgan Stanley looking at the banks and saying that with all else being equal, they calculate that every 25 basis point rate cut reduces margins at our big 4 banks by around about 2 to 3 basis points, and also earnings by 1.5 to 2.5%. They say that rate cuts are driven by a weaker economic outlook, and while investors view the stimulus and the lower cost of equity as positive for bank stocks, their analysis looking back to 2013, 2015 and 2016 shows that the majors usually outperform into the first rate cut but then subsequently underperform. In 2019, they are expecting rate cuts to be less support for bank share prices. Moving on from banks to listed property, and Macquarie looking at listed property and saying that while Amazon remains a real threat, they believe that it's more of a medium-term threat. Instead, the cyclical headwinds from wage growth, cost of living and declining house prices are more of a near-term risk. They remain neutral to the retail REITs such as GPT, as well as Stockland Group and Essentia, and their sector preferences remain stocks like Lendlease, Mirvac, Goodman Group, as well as Charter Hall, all which they rate as outperform. Now, Credit Suisse looking at a New Zealand model portfolio, and given that most of these companies trade on the ASX as well, I've put it in for this week. This portfolio is benchmarked against the New Zealand 50 and looks at earnings momentum, return on capital, earnings multiple relative to Credit Suisse's discounted cash flow valuations, and of course liquidity. The overweights in this portfolio for stocks that are traded on the ASX as well include Contact Energy, A2 Milk, EBOS, Infratel, as well as Kathmandu, while there's an underweight for Fisher & Paykel Healthcare. Continuing on with stock picks, and Ords looking at key picks for its small industrials. Its top pick is Webjet, which it has as a buy, saying that the early delivery of its B2B margin target together with its new FY22 targets are a game changer. Their bottom pick, though, is Tassal Group. They say that first half growth was volume driven from pulling forward from second half demand, and an area of concern is shifting their growth strategy from salmon to prawns. They see the salmon market as being largely an untested prawn business, and they see the risk-reward matrix as unattractive. And finally, ending with Wilson and a whole lot of stock ideas. This is their conviction portfolio list. In tech, they like ARC Group on valuation, Bravura with the large potential for the wealth management market, EML Payments for reloadable as well as non-reloadable cards, with the key segments being gaming and corporates. In food and agriculture, they like Collins Food as well as Ridley Corp. In health, it's Citadel as well as ImpediMed. In financials, Equity Trustees and Pinnacle. In the consumer space, Noni B. Mining services, they like Austral, Mastermind, as well as NRW. But let's concentrate on a few of their portfolio changes where they've included Citadel. They say that the outlook for contract wins is strong, and they've also included EML Payments. They see further upside to growth from US online sports betting, which is a big market opportunity, and they say watch out for the FY20 guidance, which is due in November. So all in all, a positive start to the month of April for the Australian share market and tracking in line for the 4th consecutive month of gains. I'm Julia Lee, an equity strategist at Bell Direct, and hope to see you next week.